Hi everyone, welcome to another weekly Forex forecast. My name is Justin Bennett with Daily Price Action, and in today's video we're going to talk about the EURUSD, the Pound USD, the New Zealand dollar versus the USD, as well as the Australian dollar versus the Canadian dollar, and we're going to wrap things up with gold. So the markets have been pretty choppy lately, but I'm going to show you what I'm watching as far as breakout opportunities. So let's get started right now. A quick disclaimer that today's video is for educational purposes only. All views are my opinion and are not intended as investment advice. Forex is a high reward, high risk business, and you should not trade with borrowed money or money you cannot afford to lose. See the description of this video for the full disclaimer. Before we get started, be sure to hit that subscribe button below and also click the bell icon so you get notified every time I post these videos. So first up we have the EURUSD, and I've been talking about this 109.90 area for quite some time. So I mentioned it last weekend and again this past week. So it's actually a confluence of support because we have this ascending channel, which if you remember from last weekend, I said that this bottom level had not been tested yet. But based on all of these lows and these highs, this lower portion right through here looked like it would be significant. And 109.90 was also where the pair broke out from in October, and it retested that level exactly. We also have several lows through this area as well as highs. So 109.90 has been a key factor for some time, and you can notice how Friday's session did bounce right from that region. And this is precisely why I favor trading from the daily charts. So those who tried to sell the euro as the pair was moving below this area on Friday. Okay, so when you saw this intraday move below 109.90 and you tried to sell, those people got faked out, and this strong push higher into this area on Friday probably stopped those traders out. So I was waiting on the sideline to see what happened on the daily close. I don't want to trade this type of intraday movement because, as I've said in the past, that is really, in my opinion, just noise. What matters is where the market closes at 5 p.m. Eastern, which is why I use New York close charts. Now, Friday did technically form a bullish engulfing range. Notice how the high of Friday and the low engulf several candles last week. However, the close on Friday was not that strong in my opinion. So notice how long this upper wick is. Friday did not close near the highs. So I still have to respect the potential for a push higher this week as long as 109.90 is intact on a daily closing basis. However, as I just mentioned, Friday's close was not that strong. So whether or not this is a buy signal is really up to you. And I would have liked to have seen the EURUSD close near Friday's highs and form a stronger bullish engulfing candle. So as of right now, we could get a rotation back into the support area. And as long as it holds, again, I have to respect the potential for a move higher, perhaps back up into 110.70 that we've been talking about now for several weeks. The only thing that would cause me to get bearish the EURUSD and potentially sell it would be a daily close below this 109.90 level. All right, so until we get a daily close at 5 p.m. Eastern below this area, I have no interest in selling the euro. If we do get a close below it, we could see a move back down here to these year-to-date lows just below 109. However, as long as we're above it, I do think that 110.70 is exposed. And if we see the pair close above that, it could take us up to that 111.70/80 area, which was that double top from earlier this year. One thing to keep in mind if you are thinking about selling the euro is that this bullish engulfing month from October is still intact. So I talked about this one a couple weeks ago, and notice how this October low was just below the September low, and the high was obviously well above the September high. So this is a bullish engulfing month that we had in October. Furthermore, if you notice where the EURUSD just bounced from 109.90, that is actually the 61.8% retracement of that October range. So here on the daily chart, we can see that this low up to these highs, this right here was the October range. So from this low right here to this high, this is the October range. And if we notice, this 109.90 level is very close to that 61.8% Fibonacci retracement. So that adds to the confluence of this area, and it's something to be mindful of as we move forward, because again, it's going to take a daily close below it to expose lower levels, and as long as it is intact as support, I have to respect the potential for a push higher this week and perhaps into next week. The British pound versus the USD, or GBPUSD, has been in consolidation now for quite some time. So this has been if I'm honest, a pretty boring pair to watch, and especially trade. I have not traded it for quite some time because we have seen this consolidation continue above 127.70 and below that 130 handle. So I talked about this one recently and said that I would not trade it until we get a close above this area or below 127.70. And so far we have not gotten that. Last week, we did bounce back from that Friday low and maintain this range, because if you remember 2 weeks ago, it looked like we were going to get a rotation lower into 127.70 and perhaps even a break below it. But last week did save that, and for now, the pair is still in this sideways consolidation. And although buyers still have work to do, I would not be surprised to see an eventual close above this resistance level over the coming weeks, simply because we still have this short-term uptrend. We have this higher low and we have a higher high. So this is potentially a higher low from this one back here. However, in order to confirm that, we do need to see the pair start to push higher once again. So as long as we're in this consolidation, there's still a big question mark on where the pound goes. But based on this short-term uptrend and this sideways movement after this huge rally back in October, I do have to respect the potential for a break higher. So a close above 129.80, perhaps 130, would take us up to the next resistance at 131.70. Alternatively, a daily close below 127.70 would expose the next key support around 125.70. Next, we have the New Zealand dollar versus the US dollar, or NZDUSD. And this is another market that has been moving sideways for quite some time. So notice how we had this retest of 164.30/40. And based on these highs back here, these lows, this was a key area we were watching. So we had this retest, bearish pin bar formed. We then had to move back down here into the 163.20 area. Then we had a bearish engulfing candle form at the same area. So two sell signals right here and right here. Again, that moved back into 63.20. And we've since rallied back to resistance right around 164.30/40. Now, some traders may see Friday's candle as another sell signal. So notice how we had this move up into 64.40, and the pair formed what is sort of a bearish pin bar, however, not quite in my opinion. Furthermore, I don't want to sell this because this right here is simply sideways movement. I don't see this as a sell signal, even if we had gotten a wick way up above this area and a well-formed pin bar. I would not want to trade this simply because if you sell right now, you're selling right into these lows. Furthermore, whenever you see a market start to press higher and form these higher lows into resistance like this and then just churn right below it, that can be a sign of an imminent break higher. So I don't want to sell the New Zealand dollar right now, but I also don't want to buy it because we are still below that key resistance area. So just like the British pound, it's going to take a daily close above resistance, this time at 64.30/40, in order to expose the next key resistance up around 64.90. Now, a close above that could take the pair as high as 65.80. But for right now, we do need that close above resistance in order to entertain a long opportunity. We could also see another rotation back into support at 63.20. So that's still a possibility. However, I would not want to sell this again while we are in this sideways consolidation. Furthermore, I want to point out that this potential inverse head and shoulders is still technically intact. So we have the left shoulder over here. We then had the right shoulder, and we thought this was going to be the low of the right shoulder. However, we had that second rotation into support, and then that move back into resistance, which could also be a neckline up around 64.30/40. So for right now, this left shoulder, the head, and this larger right shoulder could still be an inverse head and shoulders that could trigger a move higher. But until we see that daily close above the neckline / resistance, this pattern is not yet confirmed. But regardless, this is a pattern I'll be keeping an eye on just in case we do get that push higher over the coming days and weeks. Next up, we have the Australian dollar versus the Canadian dollar. And this is one that I mentioned last weekend as a pair that could go either way. So we initially thought that this could be, and it still may be, to be honest with you, a inverse head and shoulders based on this movement right here. However, we also had this wedge pattern based on these lows through here and this upper level based on these two highs. So last weekend I said that this could go either way, and the way to tell would be a daily close either above this area or below support. And notice how on Thursday we did get that close below support. So Thursday's session actually closed right below that wedge support. And then notice how Friday did move above that level intraday, but then crashed right back down into the close. So for now, this wedge bottom is acting as new resistance. And as far as how low the Aussie CAD could go, if we look at these lows back here at what we thought was a left shoulder, so right around that 8,900 area, notice we have all of these lows through here. And we also have some lows just below that. So this 8,900 area is going to act as support. It's likely going to attract sellers if we do see the Australian dollar versus the Canadian dollar push lower. And if we break that, of course, we're looking at the year-to-date lows based on this candle back here. So as long as the pair stays below this wedge bottom on a daily closing basis, I do think that this move is a very real possibility. If we see the pair close back above this level though, then that would signal that this was a false break, and it would also likely trigger a move higher, perhaps up into that wedge top. So as of right now, I am relatively bearish the Australian dollar versus the Canadian dollar, looking for a move down into that 8,900 area as long as this wedge bottom is serving as new resistance. Last but not least, we have gold or XAUUSD in the spot market. And the pair has consolidated now for quite some time. So remember that we had this rally that occurred back here between May, and then we had this top up here in August. So since that time, gold really has been consolidating. Yes, this is a move lower. This is a short-term downtrend based on these lower highs and also lower lows. However, because of this uptrend we saw back here, this consolidation right here looks relatively constructive, in my opinion, for another push higher. So if we had seen this market come up and retest this high and then start to immediately sell off aggressively, that would not be a constructive consolidation for another leg higher. However, if you look at the angle of this rally compared to the consolidation, so if I draw a line from this low up to this high, if you notice that angle versus the middle of this consolidation right here to last week, notice the angle of this rally versus the consolidation. So this is what I talk about a lot, and this signals a massive influx of buying pressure. And this right here, yes, there is selling pressure, but not nearly as much as what we saw back here when buyers were in control. We also saw the XAUUSD retest that confluence of support right around 1450 recently. So this 1450 area is a key horizontal level, and it's also the bottom of what could be a falling wedge. So since then, the pair did bounce higher, and we'll have to see whether or not last week was a slightly higher low from that retest around 1450. If it was, we could see gold start to rotate higher back into that wedge top. Furthermore, a falling wedge like this does tend to trigger a break higher more often than a break lower. So right now, as long as this bottom is intact as support, I do have to respect the potential for another push higher from gold. Just keep in mind that this consolidation is going to continue until we get a daily close above wedge resistance up here. So as long as we see gold just chopping sideways like this between these two levels, so this resistance level and this support level, as long as we see the pair between those two levels, this is just consolidation. If we do see a close above this and the level becomes new support, that could give us that next leg higher based on this rally back here. So notice this rally, consolidation, break higher, rally, and now we've had consolidation. So right now I am waiting for a break above this area for a move back up into the year-to-date highs around 1550. Alternatively, if we see gold crash lower and close below that wedge support, that could trigger a move down into 1380 support based on some of these lows back here. So in my opinion, there isn't much to do here right now, but based on some of these moves we've seen from gold recently, especially these rallies, this is not a market you want to sleep on. So I would keep this one on your radar, because if we do get that breakout, we could see gold take off just like it did earlier this year. If you enjoyed this video, give it a thumbs up, leave your comment below, and be sure to subscribe to my channel. See you next time.